All right, let's get right into it. In this explainer, we're going to step beyond the usual spreadsheets and algorithms. We're about to explore a completely different kind of data layer, one that's designed to help time the very surprises that really move the market.
So, let's kick things off with a classic head-scratcher, one I'm sure every single one of you has seen. A company drops a stellar earnings report, and what happens? The stock tanks. Or the opposite. Some awful news breaks, and the price barely even flinches. Now, this isn't just random chaos. It all comes down to a core principle of how markets actually work. To really get a handle on this, to make sense of this seemingly bizarre behavior, we have to master the concept of market expectation. You can think of it like a ghost in the machine, this invisible force that, more often than not, matters way more than the news itself. Okay, so here's the absolute crucial point. The one thing to really let sink in. Markets don't react to information, they react to new information. It's all about the surprise. They're reacting to the delta between what everyone thought was going to happen and what actually happened. That gap? Well, that's where both the profit and the risk live.
And this table just lays it out perfectly. Look at that first scenario. Positive news was expected, it gets delivered, and the reaction is to sell. That's your classic sell the news event, right? Traders who bought the rumor are now cashing out. On the flip side, if everyone is bracing for bad news and it finally hits, that can actually mark the bottom. The real action, the big moves, they come from the unexpected. A genuine positive surprise can send a stock soaring, but a negative surprise, well, that can be absolutely devastating.
So, if we all agree that surprise is the key variable here, the next logical step is to understand its anatomy. As analysts, our job is to figure out where these shocks are most likely to come from. And you know what? They're not totally random. They tend to fall into some very distinct buckets.
We can basically group these high-impact events into three main domains. You've got your scheduled reports like quarterly corporate earnings, you have scheduled meetings like the big ones from central banks, and then you have the completely unscheduled stuff, the geopolitical shocks that come out of nowhere. Each one has a different risk profile for sure, but all of them have the power to move the entire market.
And just look at the massive difference in market reaction here. A quarter-point hike from the Fed that everybody and the brothers sees coming, it's pretty much a non-event. But a surprise half-point hike, that creates insane volatility, especially in the currency and bond markets. The real challenge for any predictive model is trying to anticipate that deviation from what everyone else expects.
This same idea applies to those totally unscheduled events too. A geopolitical crisis, like the attempted coup in Russia, presents two sides of the same coin. The immediate reaction is danger, right? Panic, volatility. But for analysts using a different toolkit, one that might have anticipated the event would be over quickly, that very same panic created an incredible, highly profitable entry point.
And this all leads us to the core idea of this entire analysis. What if there was a structured, non-traditional data source that could help us anticipate the timing of these market-moving triggers? Now, let's be crystal clear about the framework we're talking about here. The idea is not that planets cause a market to crash or a central bank to raise rates. Not at all. The thinking is that planetary alignments can act as a triggering mechanism. They can activate and amplify the potential energy that's already built up in the system.
The best analogy comes straight from physics. Think of a big market trend as a massive heavy object. It's already got its own momentum. The news event, that's the force you apply to it. But the planetary alignment, that's the fulcrum. If you apply that force at precisely the right time and place, you can use a relatively small push to create a hugely magnified effect.
Okay, so theory is great, but let's put this trigger framework to the test with two real-world case studies. They could not be more different, and they perfectly illustrate how this works for both risk and opportunity.
First, let's look at the setup, the background conditions. Back in 1993, IBM was a dinosaur. Everyone had written them off. All the bad news imaginable was already priced into the stock. The company was literally primed for a positive surprise. Now contrast that with Orange County in 1994. They were making a massive all-in leveraged bet on one single outcome, that interest rates would stay low. Their entire portfolio was brittle, just waiting for a negative shock.
And then the triggers hit. For IBM, it was an earnings report that was way stronger than anyone expected. That was the positive trigger, that small force applied to the lever that just ignited a monster recovery. For Orange County, the trigger was a surprise Fed rate reversal. That negative trigger led to a complete catastrophe. The outcomes are polar opposites, and they drive home just how critical it is to understand the background state before a trigger ever arrives.
But look, any robust model has to have a way of accounting for its own limits.
Even inside this astrological framework, there's a variable that, by its very definition, stands for the truly, deeply unexpected.
In this kind of analysis, the planet Uranus is basically the variable for genuine black swan-level shocks. When its influence is really strong in a chart, it's a warning sign to an analyst that the outcome is probably going to defy any simple, straight-line prediction. It's kind of like the system's own built-in chaos factor.
A great example of this is when a powerful Uranus aspect showed up in Japan's national horoscope. A lot of people were thinking, literally, earthquake. But what happened? A political earthquake that completely shattered the ruling party's grip on power and remade the entire post-war landscape. The energy showed up, just in a surprising, metaphorical way.
So the big question is, how do we pull all these different ideas together into a practical, actionable process you can use when you're looking at a big, scheduled news event on the calendar?
Well, this integrated checklist gives you that exact framework. 1. Is what everyone expects already baked into the price? 2. What are the background conditions? Is this stock coiled like a spring, ready for good news? Or is it on thin ice? 3. What are the potential triggers, both good and bad? 4. And this one is so important. Know what you don't know. This is a co-specialty field. Either find the data yourself or partner with someone who has it. And finally, step 5. Cross-reference what Wall Street thinks is going to happen with the astrological chart for the event. If those two things are telling you different stories, you might just have found a very high-value contrarian trade.
And, this isn't just a reactive tool for trading the markets. These same principles about timing can be used proactively in corporate strategy. The ABCs of damage control become A, admit the problem right away, B, outline exactly what you're going to do to fix it, and C, release that plan to the world at a moment when the astrological weather is most favorable for it to be received well.
Which really leaves us with a final thought, something for every quant analyst to chew on. We spend our entire careers trying to find the signal inside all the noise. The question this framework really asks is some of that noise actually a complex rhythm? Is it a kind of clockwork that's been ticking all along, and we just haven't had the right charts to see the pattern?